Marcus saved everything the right way. Maxed his 401k every year for 30 years. Never touched it. Watched it grow. At 65, he had $1.2 million sitting in his retirement account, and he felt like he had won. Then his financial planner showed him his projected tax bill in retirement, and Marcus went quiet for a long time. Here is the thing nobody tells you when you are 25 and your HR rep is walking you through open enrollment. The entire mathematical foundation of the traditional 401k rests on a single assumption. One assumption. And if that assumption is wrong, the tax-deferred account you have been feeding for decades does not save you money. It postpones your tax bill to a future version of yourself who may be in a worse position to pay it. That assumption is this: you will be in a lower tax bracket in retirement than you are today. That sentence sounds boring. It is not boring. It is the load-bearing wall of the entire American retirement savings model, and for a growing number of middle-class households, it is cracking. Let us stay with Marcus for a moment, because his numbers are real and his situation is not unusual. He retired at 65 with $1.2 million in a traditional 401k. No Roth. No taxable brokerage. Just the tax-deferred account he was told was the smart move. His Social Security benefit is $28,000 per year. He planned to withdraw about $50,000 from his 401k annually to cover living expenses. That puts his gross income at roughly $78,000. After the standard deduction for a single filer in 2024, which is $14,600 according to the IRS, he is looking at taxable income around $63,400. That lands him squarely in the 22% federal bracket, meaning only the dollars above the bracket threshold are taxed at that rate, not every dollar he earned. But the bracket he occupies is the same bracket he was in during most of his working years. Now, to be fair to the original logic of deferral, by keeping that tax money invested for 30 years, Marcus did get the benefit of compound growth on dollars he would otherwise have sent to the IRS. That is real value, and it is why the strategy made sense for decades. Mathematically, if your contribution tax rate and your withdrawal tax rate are identical and your returns are the same either way, a traditional account and a Roth account often produce equivalent outcomes in isolation. The deferral benefit does not automatically win. What breaks that equivalence is everything that happens on top of the withdrawal itself. Forced income stacking from RMDs, the loss of flexibility to manage your tax exposure year by year, and the real possibility that rates in the future are not the same as rates today. Those are the actual vulnerabilities. And as we are about to see, for many middle-class retirees, they stack in the worst possible order. But that is only Act 1 of the problem. At age 73, the federal government stops letting Marcus decide how much to withdraw. Required minimum distributions kick in, and the IRS uses its uniform lifetime table to calculate the minimum he must take each year. At age 73, the divisor is approximately 26.5. On a $1.2 million balance that has continued growing at a conservative 5% annually since he retired, Marcus's account is now worth roughly $1.53 million. His required minimum distribution that first year is approximately $57,700. Add Social Security, and his gross income jumps to about $85,700. Now he is moving deeper into the 22% bracket, and as the account grows faster than he spends it, future RMDs push him toward the 24% threshold. This is what financial planners call the RMD trap. You defer taxes to avoid them. The account grows. The government forces you to take larger and larger withdrawals whether you need the money or not. And every dollar of that income is ordinary income, taxed at your marginal rate, with no preferential treatment for long-term capital gains. Here is the thing you need to hold on to, because what comes next is where the real math gets strange. Marcus's Social Security benefit is $28,000 per year. He thinks of that as mostly tax-free income, the way most Americans do. But there is a threshold structure built into the tax code, established in 1983 by Congress and documented by the Joint Committee on Taxation, that has never been adjusted for inflation. It works in two tiers. For a single filer, once your combined income, which the IRS defines as adjusted gross income plus non-taxable interest plus half of your Social Security benefits, crosses $25,000, up to 50% of your Social Security benefit becomes taxable. cross $34,000, and that rises to 85%. This is not a cliff where $1 tips your entire benefit into a higher tax rate. It is a tiered structure. But the tiers are close together, and most retirees with any meaningful savings income clear both of them without realizing it. Marcus crossed the $34,000 threshold in year one of retirement. 85% of his $28,000 Social Security benefit, or $23,800, is now included in his taxable income. This is a tax exposure most retirees significantly underestimate, and it compounds year over year. Because Congress set these thresholds in 1983 and never indexed them to inflation, the Urban Institute has documented that the share of Social Security recipients owing federal income tax has risen from roughly 10% in 1984 to over 50% today. The issue is not that anyone was deceived. The issue is that bracket creep and non-index thresholds have quietly pulled millions of ordinary retirees into a tax situation that did not exist when the rules were written. Marcus is not a high earner. He is the middle class, and the middle class is increasingly caught in a structure that was designed for a different income era. Now at Medicare, the income-related monthly adjustment amount, known as IRMAA, is a surcharge on Medicare Part B and Part D premiums triggered when your modified adjusted gross income exceeds $103,000 for a single filer in 2024, according to the Centers for Medicare and Medicaid Services. Marcus is below that line, but his neighbor Derek is not. Derek retired with $1.8 million in a traditional 401k and a pension paying $40,000 a year. His RMDs at age 73 push his income above $103,000. His Medicare Part B premium, which is $174.70 per month at the standard rate in 2024, jumps by $69.90 to $244.60 per month. That is a 40% increase in his premium. That is an additional $839 per year, and it scales higher in further income tiers. Functionally, it behaves like an additional marginal income penalty, one triggered directly by the retirement account income the 401k was supposed to produce efficiently. This is the part most retirees never see coming. Multiple systems begin stacking on top of each other. RMDs force income. That income pushes Social Security into taxable territory. The same income triggers Medicare surcharges. And underneath all of it sits one more risk that most retirement projections quietly ignore. Tax rates are not fixed. They are a policy variable. The Congressional Budget Office projected in its 2024 long-term budget outlook that federal debt held by the public is on a path to reach 166% of GDP by 2054 under current law. Debt service costs are already the fastest growing line item in the federal budget. Higher future tax rates are not guaranteed. Spending cuts, economic growth, entitlement reform, or a shift toward consumption-based taxation could all alter that trajectory. But the arithmetic creates meaningful upward pressure on future rates that any honest retirement analysis should account for as a real possibility, not a certainty, but a possibility worth pricing in. When Marcus deferred taxes in 2005 at the 25% rate that existed then, he was making a bet about the future. That bet has a real cost if it does not pay off. So what do the people who actually understand this do? They do not abandon tax-deferred accounts entirely. The employer match is still free money, and capturing it first is always the correct first move. One important note here. Your employer's matching contribution goes into the pre-tax bucket regardless of how you direct your own contributions. Even if you elect a Roth 401k for your personal deferrals, the match your company adds will almost always be pre-tax under the plan rules. That means some portion of your 401k will be taxable in retirement no matter what. The goal is not to eliminate that bucket. The goal is to avoid making it your only bucket. And for high earners currently in peak income years, traditional deferral can still be the mathematically superior choice. If your marginal rate today is significantly higher than your projected rate in retirement, deferring now and paying later still wins. The strategy is not one size fits all. It is about matching your tax treatment to your actual rate exposure across time. They treat tax diversification the way a sophisticated investor treats asset diversification. They do not put every dollar into a single tax treatment. They split contributions across traditional pre-tax accounts, Roth accounts funded with after-tax dollars that grow tax-free, and taxable brokerage accounts that generate long-term capital gains taxed at preferential rates. Think of it as building 3 tax buckets simultaneously. Bucket 1 is your traditional pre-tax account, growing now, taxed later at ordinary income rates. Bucket 2 is your Roth, funded with after-tax dollars today, growing and withdrawing completely tax-free in retirement. Bucket 3 is a taxable brokerage, where qualified dividends and long-term capital gains are taxed at 0, 15, or 20%, depending on your total income. According to the Tax Policy Center, a married couple with $100,000 in long-term capital gains income and no other earnings would owe 0 federal tax on those gains under current law. That is not a loophole. That is the designed preferential treatment for investment income, and it is available to anyone who builds a taxable account alongside their retirement accounts. State tax environments vary significantly here. Someone deferring income in a high-tax state like California or New York and retiring to a no-income tax state like Florida or Texas captures real additional value from deferral. Run your own state-level numbers before assuming the federal picture tells the whole story. Priya is 41 and earns $110,000 a year. She currently puts 12% of her salary into a traditional 401k and gets a 4% employer match. That is a reasonable starting point. But she has no Roth, no taxable account. Every dollar of her retirement savings will come out as ordinary income. The real risk is not just the tax rate she will face. It is the lack of flexibility. When every dollar is in a single tax treatment bucket, she has no lever to pull in retirement. She cannot draw from a tax-free source in a high-income year to avoid crossing an IRMAA threshold. She cannot let a taxable account generate zero-rate capital gains. She has one option, and that option has RMDs attached to it. When she runs her projected income at 73, stacking her Social Security benefit, a small pension from her employer, and RMDs from a projected $1.4 million balance, she is looking at roughly $95,000 in gross income in year 1 of forced distributions. That puts her at the edge of the IRMAA surcharge threshold, and 85% of her Social Security becomes taxable. Her effective tax situation at 73 is materially worse than her effective tax situation at 41. She spent 40 years making the tax problem bigger without realizing it. The fix Priya has available right now costs her nothing in terms of total contributions. She redirects half of her voluntary contributions above the employer match into a Roth 401k, which most large employers now offer following the Secure 2.0 Act of 2022. Same dollars, different tax treatment. She is paying taxes on those contributions now at her current marginal rate. But the growth is tax-free, and critically, Roth 401k accounts when rolled over to a Roth IRA have no RMD requirements under current law. That money will not be forced into her taxable income at 73. She is shrinking the future RMD problem before it starts. The Roth conversion ladder is the most powerful tool for people already sitting on large traditional balances, and it works best in the years between retirement and RMD age. If Marcus retires at 65 and delays Social Security until 70 to maximize his benefit, he has roughly 8 years when his taxable income is artificially low. During those years, he can convert chunks of his traditional 401k into a Roth IRA, paying taxes at his current low rate and permanently removing that money from the RMD calculation. Every dollar converted before age 73 is a dollar that will never generate a forced distribution. It grows tax-free and passes to heirs without income tax. The logic is straightforward. You are choosing when to pay the tax. The question is whether your rate today is lower than your rate at 73 when RMDs, Social Security, and investment income are all stacking on top of each other. For Marcus, a $200,000 conversion spread across 5 years in the 12% bracket saves him from paying 22 to 24% on those same dollars as RMDs a decade later. The difference is measurable, and it compounds. There is one more piece of this that reframes the entire system. The 401k was not designed as a primary retirement vehicle. That is documented history. Ted Benna, the benefits consultant who developed the first 401k plan in 1980, has said publicly that he never intended it to replace pensions. It was a supplemental savings vehicle. Congress embedded it in the Revenue Act of 1978 as a footnote, Section 401k, a provision allowing employees to elect to receive compensation as deferred income. The mass rollout to ordinary workers happened over the following decade as companies phased out defined benefit pensions to reduce their liability. The account structure, including the tax deferral mechanics and the RMD rules, was never redesigned for a world where it became the sole retirement savings mechanism for the entire American middle class. That is not a conspiracy. It is an institutional mismatch. A tool built for one purpose is now carrying a load it was never engineered to support. And the tax assumption buried inside it, the belief that your future self will be in a lower bracket, is an assumption that was plausible when tax rates were higher across the board and middle-class retirement income was lower. It is a far shakier assumption today. Here is the reframe Marcus needed, and the one worth carrying out of this video. A traditional 401k is not a tax savings account. It is a tax timing account. You are not avoiding taxes. You are choosing when to pay them. That single distinction changes every decision downstream. The right question is never just how much should I contribute. It is what tax rate will I face when this money comes out, and is that rate lower or higher than the rate I face today? If you cannot answer that with some specificity, you are making a decision whose full cost you do not yet understand. The people who build lasting wealth from retirement accounts are not always the ones who contribute the most. They are the ones who think most clearly about when the government gets paid. And then they arrange their accounts so that when the bill arrives, they are holding the lower rate option. If this shifted how you think about your retirement accounts, the next step is to run your own numbers. The IRS RMD worksheets, the Social Security Combined Income Worksheet, and your current tax bracket are all free public resources. The math will not be comfortable, but it is better to run it now than to sit where Marcus sat, looking at a number you spent 30 years building, realizing the assumption underneath it was never guaranteed.